Hello and welcome. Today we're working on what if we set up a portfolio with a mix of stocks and bonds, and what would happen to the future value and the return and the risk of that portfolio. So let's get started. Hello, my name's Jeff from finallylearn.com, where I help you finally learn financial skills. So here's what I have. I have a setup where we'll have stocks and bonds in the total portfolio. And I have in a previous video, I had the 50-year returns of the S&P 500, the 10-year Treasury bonds, and the 3-month Treasury bills. We're not going to use Treasury bills. We're just going to use stocks and bonds for 50 years. And so let's see what we have with a portfolio. And also we're going to say, well, what if we have different percentages? And so we'll do kind of a what-if analysis. So let's start with $2,000 initial investment. I just typed that in. And let's do a stock and bond percentage. And let's say we want a range. So over here, kind of out of view, I typed in stocks percentage of 0% stocks, 30, 50, 70, 90, and 100. So we have 6 different portfolios we can check on really easily. So here's what I want to do. I want to have this where we have a drop-down list. And so I'm going to go to data, the data ribbon here. And on the data ribbon, I'm going to do data validation. And data validation, I'm going to select the list. And the source is going to be the list that I just did, 0 to 100%. So that's going to be our stock drop-down list. And so what we have over here is the only things that it'll accept is 0, 30, 50, 70, 90, or 100%. So let's do a 50-50 portfolio right now, because I can check my numbers from the previous video and see how it works. So here's what we want to do. We want to start with a portfolio of 100%. And if it's 50% stocks, then I'm going to take 100% minus the 50% stock, and we end up with 50% bonds. So what that looks like is the 2,000 times the 50%. That's going to be 1,000 invested in stocks. And then we'll do the same thing, 2,000 times the 50%, well, 1,000 invested in bonds. A 50-50 portfolio would be half in stocks, half in bonds. And we can change this. Let's check our work. What if it's 70% stocks? What if it were 100% stocks? And so then what we need to do is add up. I'm going to use the sum function and add up the total. So let's go back to 50-50 so we can check our work here. So now what we have, let's assume that we have $1,000 invested at the beginning of 1971. So 1,000 times, start my parentheses, 1 plus, I'm going to my 50-year returns, and that's 14%. And so our return of 14% will give us 1,000 plus another $142. So let's calculate that return, that total, times 1 plus the second year return in 1972 would be 18.76%. And so what we have is the 1356. I should be able to copy this across and get 1,097. Now it looks like 9.7% was our return for bonds, and it was the first year 9.79, or right at 9.8. And then we can copy this down across, and we should be able to copy all this down all the way. So let's check our work. We have the total stock account would be 168,000, and bonds would be 28,000. Now, if we check our work over here, we did a risk and return video, and so our answers are 168,000 and 28,000, so we know we have it correct. So we're assuming, one reason we did 2,000 because we could get the 1,000 in each and make sure we're checking our work. So the total portfolio would be the 1142 plus the 1097, and so our portfolio would be 2240. It'd be half of the returns would be from the stocks, half of the returns would be from the bonds. So one thing we can do is we can calculate the rate of return. we can take the 2240 divided by the 2000, and we'll get 112%, and we're going to take that, then just subtract out the original amount, the 1, and so our return is 12%, and we can do that all the way down. So we're going to take the 2485 divided by the 2240, and then subtract out the 1 for the 100%. So we got a 10.94% return. So if we look at it, we got in between the 18 and the 2, so it looks like it's about a 10% return. So you have a blended return. So let's copy that all the way down. And so here's our returns for all 50 years. So how well do we do? What's our future value if we did this? Well, our future value is going to be the bottom number here, $196,000. So if we had a blended portfolio of $2,000, 50% stocks, 50% bonds, then our portfolio value is going to be $196,876. So what is our compounded annual growth rate? Well, we can use an RRI function, and the RRI function is, we need the number of periods, and I'm just going to type in 50. The present value is the beginning 2000. The future value is going to be what we just calculated, that 196,000. So we got a blended return for the portfolio of 9.61%. And we can calculate then, well, how risky is that return? We can compare it to standard deviation, compare it to the other returns. So the standard deviation, I'm going to do standard deviation, and I'm going to use the standard deviation of the sample, and we'll highlight the entire column, close our parentheses. So how risky is our portfolio? Well, about 12%. And on our previous video, we had the standard deviation. So we have just a little bit more risk than a bond portfolio, but a lot less risk than the stock portfolio. And we had a 9.6% return versus what it would be at 100% stock return would be like 10.8%. We can also figure out our 5 worst years. So we're going to use the small function. The small function, the array, is going to be, I'm going to highlight all this, and I'm going to make it absolute. There's other ways to do this, but I'll make it absolute. And then I'll point to the number 1. So our worst year is 23.15, and we can copy that down. Here would be our 5 worst years. Now remember, on the stock market, the worst year was 2008, about 36.5% negative return. So now we have this. So this is a 50-50 portfolio, but what if you want to do a what if 0%, so on? So let's just test that it works. At 0% stocks, you should get this is the essential bond return. At 100% stocks, then we have 0% bonds, and this is the stock market return. You would end up with $337,000. If you did 50-50, $196,000. If you did 100% bonds, you would end up with, 0% stocks, 100% bonds, you'd end up with $56,000. So it makes a difference how you allocate that portfolio. So here's what you could do. You could have it where you can have separate tabs. You can easily do that. So let's set this one up to be 100% stocks. So I'm going to change this to 100 and 0 portfolio. And so this would happen if we had 100% stocks, 0% bonds. And we can right click, move or copy. Move to the end, we're going to create a copy. And so we're going to change this from 100%, let's change it to the next one down, something like 90%. So you can see what happens. Our risk is a little bit less, our returns a little bit less, our portfolio is a little bit less. So we're going to call this a 90-10 portfolio. Then we can copy this, right-click it, move or copy. Go to the end, create a copy. And so this one, identical copy, we're going to make this 70%. So we're going to call this a 70-30 portfolio. And so you start to see our portfolio went from 337,000 to 309 to 253. Our return is going down, but our risk is going down. Let's do one more, and you can see you can do it for all 6 portfolios really easily. Move or copy, move to the end, create a copy. And so this is the 70-30 portfolio. We're going to make it 50-50 portfolio. And we'll change this. I've already got that taken here, so change this to 50%, and you can see what happens over time. If you have more stocks, you have higher risk but higher returns over the last 50 years, and a 50-50 portfolio, you have less returns, less risk, and so you can kind of figure out what kind of portfolio that you would have. So if you invest in index funds, you could invest in the S&P 500, and you would have had those returns essentially over the 50 years. All right, thanks for watching. We'll see you on the next video.